Hey, good morning, everybody. This is Bill with NotaryCoach.com. Today I want to talk to you a little bit about what private mortgage insurance is and how you might have a conversation about that with your borrowers that are in a signing. The cool thing about it is we don't have to dive into a lot of detail as a signing agent. In fact, the loan officer and the loan processor have probably already reviewed this. But when you're buying a new home, or even if you're refinancing, the mortgage process, it can be a little overwhelming. And these borrowers are inundated with disclosures and information. So a lot of times they'll just completely forget that they've ever talked about it. So private mortgage insurance is required by a lender to help protect their investment. It is insurance that only protects the lender, not the borrower. Okay, so this is not the same as homeowners insurance or hazard insurance. This is private mortgage insurance, and it protects the lender in case the borrower was to default on their loan and stop making payments and then have to go through foreclosure. So insurance is designed to help cover whatever the difference is between auctioning the house off and the actual mortgage amount that's owed. So the borrower it's required, so they have to pay it one way or the other unless they have more than 20% equity in the house. So if somebody comes in and puts a 20% down payment, they're probably not going to have to pay private mortgage insurance. If they don't have the full 20%, then the lender's going to require this PMI, and the borrower will have two ways to pay. Number one, and this is the most common, is they'll just pay monthly mortgage insurance premium payments every single month included in their monthly payment until they reach that threshold of equity. So once they get, 20, 21, 22% equity in the house, in most cases the lender will automatically drop that off on a conventional loan. There are still some circumstances where the borrower will have to reach out to the lender and just remind them, hey, we've reached the equity point, so drop the PMI. But in most cases, even on the closing disclosure, the lender estimates when they're going to hit that equity threshold, and they just schedule the insurance premium to just automatically stop at a certain time. Now, the other option that a borrower would have is to pay their mortgage insurance premium up front. So that's called the upfront mortgage insurance premium. If they do that, then they just pay one lump sum during closing, out of their closing proceeds right there. Now that's a little outside the realm of possibility for a lot of people, so that's why they opt to pay monthly. However, there is the option to do either one. Now the exceptions to this is on FHA loans. So on FHA loans, a borrower is required to pay the PMI for the entire life of the loan. So as long as that's an FHA loan, they're going to be paying private mortgage insurance. The only way to get out of that, of course, is to, number one, pay off the house, or number two, refinance it at some point into a conventional loan or a different loan other than FHA. Then the other option, of course, that you have is the VA loan. So on VA loans, one of the perks is that the borrower does not have to pay private mortgage insurance. However, they do pay a VA funding fee up front that is, interestingly enough, it's almost the exact same amount as an upfront mortgage insurance premium might be. However, the veteran can roll that VA funding fee into their loan in most cases, so they can finance it over the life of the loan. So those are kind of the three circumstances where you're going to encounter PMI. To have the conversation, I usually, if somebody says, hey, what is this? Is that to protect me? That clear answer is no. That protects the lender. And I'll just say, the private mortgage insurance is the insurance that the lender requires that you pay that protects them in the event that you were to default on the loan. That usually triggers a little bit of a reminder, and they're going to remember having that conversation with somebody along down the road. Now, you don't dive into too much details on that. If they really have a concern or an issue with it, or it makes absolutely no sense to them, you can offer to have them call their loan officer for an explanation right then and there. And if they don't have the number, you can help facilitate, whatever you're comfortable with, just to make the transaction go as smooth and efficiently as possible. You just don't want to get into too much conversation about why it's there and how ridiculous it might be or anything like that. That's a conversation that the lender can have with the borrower. But I have to say, out of the many years I've been doing this, I've probably had one person that was completely blindsided by that and disagreed with having to pay it. And they worked it out with the lender eventually. So you're not going to run into those too often. All right, guys, my name is Bill. I'm with NotaryCoach.com. Thank you so much for watching and have a great day.